Hello dear students, we are doing retirement of a partner, and in retirement of a partner, just like in admission of a partner, sometimes the partners want their capitals to be adjusted after the retirement of a partner. There are many such situations which can be thought of by the partners to adjust their capitals. One is that they have paid the retiring partner. His capital account has been debited and cash has been credited. He has been paid and he has retired. After his retirement, the partners want that their capitals should be a different amount. I mean, if the total of their capitals is 5 lakhs, 3 lakhs and 2 lakhs, both the partners, now they want their capital to be 6 lakhs, fine, and they also want that the capital should be 3 lakhs each. The capitals account will have to be adjusted now. Earlier, A's capital is 3 lakhs, B's is 2 lakhs. Now they want that the capital should be 6 lakhs and should be equal. That means A's capital is already 3 lakhs, only B will have to bring 1 lakh of rupees more to make it 3 lakhs. This is one type of adjustment where they want that their new capital should be different from the existing capital. And sometimes the partners want only their existing capital be adjusted, meaning thereby if A has got 3 lakhs and B has got 2 lakhs, C has retired, their total capital is how much? 5 lakhs. It has to be equal or in any other ratio. If it has to be equal, that will be 2,50,000 for each. A has 3 lakhs, he will withdraw 50,000. B has 2 lakhs, he will bring 50,000. So B has brought 50,000, his capital becomes 250, right? And A's capital was 3 lakhs, he has withdrawn 50,000, his capital becomes 2,50,000. This is the first type of adjustment and is very simple. Second one is more important, and there are more variants of this second one. I am going to take one, and that is that the two partners, 3 partners, one of them retires and the 2 partners are continuing partners, right? They want to make payment to the retiring partner. Very good. They can pay the retiring partner the amount due to him. I assume that A's capital is 3 lakhs, B's is 2 lakhs and C's is 1 lakh. Final amount. After all adjustments have been made for general reserve, goodwill and everything, revaluation, profit, etc. So that means C has to be paid 1 lakh. But the partners find they do not have that much of cash with them. So they decide to bring this cash of 1 lakh from their home. Already their capitals are A 3 lakhs, B 2 lakhs. Their total is 5 lakhs. They will bring 1 lakh more from their home. That will make their capital 6 lakhs. Okay. Now they want this 6 lakhs to be equal. This is another format, another part of the adjustment. First they bring cash to make the payment to the retiring partner. And when they bring cash, their capital, total capital goes up. Now they want their total new capital in a certain proportion. It may be equal, it may be 3:1, it may be their profit sharing ratio, any one. So this is very important type of adjustment which you must learn how to treat this. For this purpose, my dear students, you will have to do at least 5-7 questions and practice it thoroughly, various variants of this adjustment. Earlier first one is pretty simple, but I am taking this second one, and for this purpose I have taken a question from the book. That question is page number 48. This question is on second type of adjustment, and it is a very interesting question and very informative question which must be practiced by you thoroughly. Follow the solution how I am doing it. Try to attack the problems in the way that I am doing it. So therefore, now let us first read the question. There are three partners, Vinod, Rajesh and Umesh. They are partners and they are sharing profits in the ratio of 3:5:2. This is the old ratio. They have a joint life policy, and look here, my dear students, some people say that joint life policy is not in course. This is not that joint life policy. Don't be allergic to it. Don't worry about this. I can replace this. This JLP can be replaced with patents. I can write here patents. I can write here trademarks, or I can write here an unrecorded asset. The treatment is the same. You may call it joint life policy, you may call it patent, you may call it trademark, you may call it unrecorded assets. Okay? So, they have a joint life policy or a patent or a trademark which they bought for 30,000 rupees. Policy was for 30,000 rupees, but now the surrender value of this policy is 5,000. I can say that they had a patent. They bought a patent long back or a trademark or an unrecorded asset, and its worth at that time was 30,000, but now its value is 5,000. That means we have got nothing to do with this value. We are concerned with 5,000, that right now it is worth how much? 5,000. And see the balance sheet. 1, 2, 3, 4 assets, and none of them is here. JLP is not here. Patent is not here, trademark is not here, unrecorded asset is not here. So treatment for this will be the same. You may call it by any name. May it be unrecorded asset. Unrecorded asset is an asset which has been recorded as zero figure. So from zero value, it can be recorded at 5,000, increase in value. And if they don't want to show it in the balance sheet, that treatment also I am going to explain to you now. So joint life policy bought for 30,000, its value now is 5,000. Balance sheet as on that date is as follows. March 31, here are 4 assets, fixed assets, stock, book debts. What are book debts? Book debts are simply sundry debtors. Other name for debtors, book debts. So cash at bank is this. So these are 4 assets, and their total is given here 88,000. And then here we have sundry creditors, employees provident fund. Perhaps you remember, it was there in admission also. Employees provident fund is not to be touched. It belongs to the employees, and the amount has to be paid to the employees when they retire. This is the earning of their life. So you don't have to touch this. This is employees provident fund, reserve fund, and workers compensation fund or reserve is this. These are the capitals of 3 partners, and here are some adjustments, some additional information. Stock is revalued at this figure 20,000. Fixed assets are valued at 50,000. There is goodwill of 24,000. There is goodwill of 24,000. Mind it, goodwill is not there. What is the value of goodwill? What is the value of goodwill? 24,000. I repeat, goodwill is not there. What is the value of patents, trademarks or unrecorded assets or JLP? What is the value? Value is 5,000. They are also not there. So therefore, the treatment for JLP, treatment for trademarks, treatment for patents or unrecorded asset will be the same as for goodwill if it is not to appear in the balance sheet. If it is not to appear in the balance sheet, goodwill is not going to appear in the balance sheet. We will record goodwill in the same way we will make a record of all these items. Do you get it? So therefore, number D, Rajesh is to be paid in cash. Rajesh is to be paid in cash. Very good. Which is to be brought in full by Vinod and Umesh. Rajesh is retiring. Vinod and Umesh will bring cash such that their capitals are proportionate to their new profit sharing ratio, which is 3:2. New profit sharing ratio is 3:2. And they have to bring cash to pay their retiring partner after they have brought cash from their home. Their total capital will go up, and that capital should be in the ratio of 3:2. This is the type of adjustment which I am going to discuss with you. Lastly, joint life policy is not to appear in the balance sheet. Of course, it is just the similar as goodwill is also not going to appear in the balance sheet. Undecoded assets do not appear in the balance sheet. None of them. So treatment will be the same for that. Okay. So now let us proceed. What is required is that we prepare capital accounts, we prepare cash account, we prepare revaluation account, and finally we prepare the balance sheet. Now please follow me and take out your notebooks and start preparing the necessary accounts, revaluation account, cash account, and balance sheet as I proceed with this. So I start with the capital accounts. I will first of write the balances by balance PD. These are the balances of the accounts 30,000, 20,000 and 18,000. So the balance is 30,000, 20,000 and 18,000. These are the balances. So I have written them. And on this side we have creditors. There is no adjustment regarding creditors. So my creditors come here, sundry creditors, as it is. Sundry creditors are how much? 15,300. Employees provident fund not to be touched. Employees provident 1,700. This is done. Reserve fund. Reserve fund is 1,000. This will go to the partners. I am going to give it to them. Reserve fund in their profit sharing ratio, and profit sharing ratio is 3, 5 and 2. 3, 5 and 2. This is the profit sharing ratio, 5 and 2. 1,000. 1,000 will 500, half of it will go to him, and 300 here and 200 here. This is the reserve fund. Reserve fund is 1,000 and 1,000. Workers' compensation fund is 2,000. And workers' compensation fund, you can see there is no claim. If there is a claim, the claim will move to the liabilities. If there is a claim of 500, claim will come here 500, and the balance of 1,500 will be given to the partners, the same way as we did in the case of admission. But in this case there is no claim here, so the entire workers' compensation fund will go to the partners in the same ratio. 1,000 will go to Rajesh, 600 will be here, and 400 here, and here goes his fund. So I have tackled all the 4 items. Come here, there are fixed assets and stocks. Fixed stock and fixed assets, they are revalued. Stock and fixed assets are revalued. Here is my revaluation account. What is stated here is stock is valued at 20,000 rupees and it is 21,000. There is a fall in the value of stock. So I will write here in this revaluation account, stock. There is a fall in the value of stock of 1,000. It is recorded here, and at the same time I record in assets also. My stock has gone down. I write here at 20,000. Actual value is 20,000. Fixed assets are 50,000, and here they are 45,000. Very good. Fixed assets have gone up, so I write here fixed assets. How much should I write? 5,000. From 40,000, they are now worth how much? 50,000. So I write here fixed assets also. New value 50,000. Okay. So these two figures, fixed assets and stock, they have been taken up and they have been written in the balance sheet also. They have been written in the revaluation also. Next two items are book debts. There is no adjustment for book debts, so this item will come as it is here, book debts. How much book debts are? They are 9,000. 9,000, yes. Book debts are 9,000. Then the next is cash at bank. Cash at bank is 13,000. And look here, my dear students, I have cash here. I write this balance of 30,000 to balance brought down. So now I have taken all the items on the liability side, all the items on the asset side, and these two adjustments have been done. I have yet to do this adjustment of goodwill. I have yet to do this adjustment of capitals, and of course this adjustment of joint life policy or for patents or anyone. You can have any name for joint life policy. If you think that it is not in course, I can give it any name to this asset. It was bought long ago but was not recorded. It is an unrecorded assets. I may call it unrecorded assets if you so like. So therefore, these adjustment 3, they are yet to be made. So let me come to this. First of all, let me close this revaluation account. Look here, in the revaluation account, this total is 5,000. This total is also 5,000, I do it, but there is a profit of 4,000 on revaluation, profit of 4,000 on revaluation. Here also, this profit on revaluation will go to partners to Vinod, Rajesh and Umesh. Ratio is 3:5:2. 2,000 will go to, because his ratio is 5. 5 is the half of 10. So half of this goes to him. And then 3 and 2. 3 will be 1,200 and 2 will be 800. You can just work out their total is, this is 2, 4 to the 8, 4 3 the 12 and 4 5 the 20. So this is the division, and where it goes, entry is revaluation account debit to Vinod, to Rajesh and to Umesh, and here I write this revaluation account profit. This is profit on revaluation. How much? It is 1,200 and 2,000 and 800. Am I clear? This is how the whole thing. Now therefore, now let us come to these adjustment for goodwill. First goodwill, I take goodwill first. Goodwill. Goodwill is worth how much? Goodwill is worth 24,000. Goodwill is 24,000. Mind it. We are going to pass entries only for Rajesh's share. What is Rajesh's share? this is 5 upon 10, or it is 3, it is 3:5:2. So, it is 5 upon 10. 5 upon 10 is 1/2, and 1/2 of 24,000 is how much? 12,000. So, we will pass entries for 12,000 only. This is Rajesh. He is going to get from Vinod and from Amish goodwill. He will get from both this amount. I have not written the amount because I know that this amount will come from Vinod and Umesh in gaining ratio. In admission, it used to be sacrificing ratio. In here, it is to be gaining ratio. Therefore, we must calculate the gaining ratio. And the new ratio, old ratio is this, between three partners, Vinod, Rajesh and Umesh. And the new ratio between Vinod and Umesh is 3:2. And you know, in this case, when the old ratio is 3:5:2, if this person goes and the ratio is 3:2, if this is the case, I told you while calculating new ratio and gaining ratio, the gaining ratio will automatically turn to be the same. Gaining ratio will automatically be turned into same. But if you want to be very sure, please calculate it. New ratio minus old ratio. Do the calculations yourself. I am not going to do it here. It is the new ratio. What is the new ratio? 3/5 and 2/5. Vinod 3/5, Umesh 2/5. What was the old ratio of Vinod? It was